Hey everyone, welcome back to Chip Stock Investor. It's Nick and Kasey.
Hey, everybody.
This discussion is part of a larger one that we had over on our live event. You can check out our live events via a Semiconductor Insider membership link in the description below, or check out chipstockinvestor.com.
For this segment, we are going to be talking about a couple of the Neoclouds, CoreWeave and Nebius. If you've been with us for a while, you know that we almost bought CoreWeave at the IPO, opted instead to take a position in Nebius early in 2025. And I think whether you bought one or the other or both, you're probably pretty happy at this point in August 2025. Let's talk about them after their Q2 earnings report.
And spoiler alert, we'll talk about a few metrics that you want to keep an eye on, especially with companies like this in the AI data center infrastructure race.
Yeah, these are capital intensive businesses. And as such, you should be very concerned with the efficiency in which they deploy capital.
We'll start by looking at our semiconductor industry flow. And CoreWeave and Nebius, we put in the tech equipment and devices end market. That's one of the biggest bubbles there on the right. They're a purchaser of NVIDIA chips or GPUs that they put in those data centers. And CoreWeave and Nebius, amongst all of these other Neoclouds, have those big enterprise software companies like Microsoft and OpenAI as their customers.
Yeah, as well as a lot of others, and a lot of AI startups as well opt for these Neoclouds that have those almost nothing but NVIDIA GPUs in them. And it's been a few months since we did our initial deep dive into CoreWeave, when we talked about Neoclouds, excluding Oracle, of course, which is kind of a whole different animal. But a lot of these customers going after a lot of the AI startups and the companies that are experimenting, hoping that one day they can be big software companies, but first they need a lot of AI training and inference. And there are a lot of these Neoclouds popping up. There's actually a new publicly traded Neocloud stock. And if you're interested in researching it, we have a platform you might be interested in.
You may have heard of this platform. We've talked about it a lot, Fiscal.ai. We used Fiscal quite a bit when we were looking at CoreWeave, even before they had their IPO. And we did all of our research about Nebius on Fiscal.ai as well.
Check them out. Fiscal.ai/CSI. Get you 15% off any paid plan. It's pretty good stuff. We have a chart or two from Fiscal in today's presentation. Let's talk about this new IPO.
Who's White Fiber?
Yeah, exactly. You can't be faulted if you haven't heard of them. They actually are a startup. They actually were just founded like a year ago. I think it was August 2024. So we're kind of seeing this startup whack-a-mole problem starting to crop up, which has got to be concerning if you're an investor in a capital-intensive industry like this. It costs a lot of money to enter this type of business. It's not cheap to build out a data center, certainly not cheap to buy NVIDIA GPUs, but lots of these companies popping up. White Fiber just had its IPO last week, raised a couple $100 million. No doubt that is going to go directly to NVIDIA since they're on NVIDIA's preferred partner list. Just a little high-level view here of White Fiber, but there you have it. Yet another Neocloud. But let's talk about one of the biggest of the Neoclouds, and especially I would say probably the biggest if you measure it by market cap, CoreWeave, which had earnings last night.
And earnings did not disappoint. $1.2 billion in revenue. They have a revenue backlog up 86% to $30.1 billion, and on an adjusted EBITDA basis, their margin 62%. But one thing that we pointed out when we first reviewed CoreWeave was their capital expenditures, and we'll talk about that a little bit more because you can see they're still net income loss, not net income positive, and their capital expenditures were $2.9 billion for the quarter.
And we'll break this down a little bit further, and we're going to do the same thing for Nebius, and then we're going to go over a couple of financial health ratios that you can calculate using these financial metrics. So 1.2 billion in revenue for CoreWeave is the first number you need to know. Let's also look at the CapEx breakdown. as Kasey said, $2.5 billion in the last quarter. Cash and equivalents on the balance sheet. So we're dropping down to the balance sheet, the bottom part of the slide here. $1.15 billion at the end of June. They're still pretty thin on cash and still pretty debt heavy. So current debt that is going to mature, $3.6 billion, longer term debt, $7.4 billion, total of $11 billion in total debt. CoreWeave leveraging their balance sheet quite a bit to acquire all of those data center assets. And just as a couple of side points here, there were some events that happened subsequent to the end of the quarter in July that we're not going to include in the financial health ratios, but you should bear in mind if you're invested in or following CoreWeave.
They announced $1.75 million of senior notes that have a maturity date in February of 2031. And then they also announced $2.6 billion in secured debt.
And the use of that debt in part will be used to pay some of those current maturities on debt on the balance sheet in the previous slide. But some of it obviously will also be used to acquire more data center infrastructure hardware from NVIDIA and friends.
And this announcement was also after the quarter ended. This was on July 7th. They're acquiring Core Scientific. Now, this isn't going to be a cash deal. This is a stock deal, correct?
Yeah, all stock. And it's an interesting one. CoreWeave using that really, really high stock price as a type of currency. But this is kind of early consolidation, I suppose you could say, of the Neocloud market. They take out one peer and another one pops up in the form of White Fiber and others, like moths to the flame here.
Okay, let's now shift over to Nebius and look at their Q2 highlights. They increased their ARR to between $900 million and $1.1 billion. This is their forecasted ARR. They had it previously forecasted at $750 million to $1 billion. And then their revenue, $105.1 million, which is up 106% quarter over quarter and 625% year over year. And we'll do the same thing here with Nebius. We'll show you their cash flow and their balance sheet.
Yeah, so there's the CapEx, nearly $511 million in Q2, just over $1 billion so far the first half of 2025. They're in a pretty good position with cash and equivalents on balance, almost $1.7 billion on hand. And then as we talked about a couple months ago, they do have those investments in some software companies like Toloka and ClickHouse. And then also they own AV Ride and some little small software companies. Those are highlighted under equity method investments and then investments in non-marketable equity securities. It remains to be seen what they'll do with those, if anything, to acquire and grow the data center part of the business. I imagine it probably will be beneficial for them to hold on to those because those software companies are no doubt also customers of the AI data center infrastructure itself. So the long and the short here is there's pretty good looking use of assets so far for Nebius. They did take out a little bit of debt in the last quarter, just under $1 billion in total balance on the balance sheet. So we're going to take all of that here and we're going to do some calculations that you should know when you're thinking about capital intensive industries like this one.
Quarterly CapEx to revenue, debt to equity, and debt to asset ratios.
Well, CapEx to revenue.
We've been talking about that one a lot lately, especially with the hyperscalers.
Yeah, I think last July is when we introduced that, and now it's pretty common. But the numbers look wacky, though, for CoreWeave and Nebius because their CapEx is higher than their revenue. Versus if you look at the hyperscalers, Amazon, AWS, Microsoft Azure, Google Cloud, Oracle Cloud, their CapEx to revenue ratios are naturally going to be less than 1.0 because they're very, very large, well-established businesses. But for these guys, 2x CapEx to revenue for CoreWeave, 4.9x CapEx to revenue for Nebius. That's because the revenues are so small. They're, of course, growing very quickly, but you're going to want to watch these metrics anyways, because over the course of the next couple of years, especially for CoreWeave, since they're bigger, you're going to want to see that CapEx to revenue approach and dip below 1.0. And same goes for Nebius as they scale up as well.
Okay, what about debt to equity? 4.2x for CoreWeave and much lower for Nebius, 0.3x debt to equity.
Yeah, and it's way, way, way too soon to compare side by side these metrics, because Nebius has yet to tap into debt very much. CoreWeave obviously has quite a lot. And for some value investors, CoreWeave is going to be a no-go because the debt to equity is at 4.2x. However, because they're using that debt to purchase some very expensive equipment that should theoretically have a pretty long lifespan, data center assets, their actual debt to assets is much lower at 0.4x. Contrast that with Nebius, just 0.3 times debt to equity. That's actually a surprisingly good ratio for a company that really is like still scaling up and at such a fast pace. So that's actually surprisingly good. Debt to assets, 0.2x. Again, this is because they haven't taken out much debt yet to fund the build out of data centers, but more metrics to keep an eye on, especially for CoreWeave, the debt to equity, that's going to need to improve. It needs to come down from 4.2x as the course of this bull market and the data center infrastructure build out craze goes on. But at this early stage, you could argue Nebius is in better position. It seems like a lot are trying to figure that out right now. We've gotten a number of questions on this. We're more comfortable having that small bet position in Nebius for this reason alone. But I think it's probably a big however. They're going to have to use debt, probably especially in 2026. They may have to ratchet up their use of debt if they want to continue building data center assets at the pace they have been so far this year. Just something to be mindful of here, and some financial health ratios you may want to keep track of, because this is very much a capital intensive industry.